Namaskar. This is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. As the world combats rising prices, demand-supply mismatches and disruptions, economic uncertainties, currency volatility, and now an imminent recession, it is the central banks rather than the governments that have been in the forefront of all these battles with their monetary policy armory. The general spearheading the war here thus happens to be the governor of the central bank of each nation and not its finance minister. That explains why in India we see the Reserve Bank Governor Dr. Shaktikanta Das battling these economic problems much more than we see our own finance minister herself doing so. The central banks, depending on the situation, either increase or they decrease interest rates or money supply in the economy to correct its direction as may be needed. As a general rule, if GDP growth falls, interest rates are pruned and money supply is increased in order to encourage spending and investments to stimulate growth. And if prices shoot up, then the money supply is pruned and interest rates are increased to discourage demand and to rein in the prices. In an interconnected world with interlinked economies and interlinked markets and seamless flow of money, the monetary policy changes by major central banks like the US Fed and like the European Central Bank, the ECB, the changes that they make have ripple effects all over, such that when the US Fed eases its monetary policy, equity and bond markets worldwide tend to be flush with money. And when it tightens its monetary policy, the reverse takes place. Such moves by central banks in the matter of interest rates and money supply cause disruptions and volatility. And that was a point of discussion in the recent MPC meet of the Reserve Bank of India. In the matter of the ongoing monetary policy tightening worldwide, Dr. Shashank Bhide, a member of the Monetary Policy Committee, observed that global monetary policy tightening to contain inflation pressures has increased the potential for significant growth deceleration and volatility in the financial markets, which we already see today. He then says that the policy response to combat inflation has been to tighten monetary policy. This policy stance by the central banks is likely to continue to achieve their inflation targets. He finally remarks that in the context of the high inflation rate, the monetary policy rate in India has increased between May to August 2022, and it is expected to continue to increase. These were the remarks of Dr. Shashank Bhide. The remarks of Dr. Ashima Goyal, another MPC member, were far more direct and apparently critical of central banks. She said that major central banks, particularly the US Fed as we see, that these banks have overstimulated their monetary policy after COVID-19 and they are overreacting to inflation now, thus creating excess volatility in cross-border flows to the emerging markets like India, as we see in the volatile FPI inflows and outflows in the Indian stock markets. Since central banks have been formulating their policies based on forward guidance estimates and not on real data, she says that forward guidance, whether hawkish or dovish, is harmful in such uncertain times. She suggests that instead of being based on forward estimates, being based on actual data allows for real sector changes to counter the effect of interest rates on the markets. She thus takes objection to the fact that monetary policy changes today have been based more on forward estimates than on real data. It is important for policymakers to stay calm to moderate their fear and their overreaction. She says this with reference to the fact that there are two mitigating factors for India and thus we do not need to panic. First, after an initial extreme reaction, the cross-border flows then discriminate on a country-to-country basis. As commodity prices soften with global slowdown, some of the investors who had left India because of its vulnerability to commodity inflation will return, she says. Second, she says that India still retains policy space for smoothing and absorbing global shocks. Domestic demand, according to her, in India can counter falling export demand, and hence our policymakers must stay calm and that they must not overreact. Dr. Ashima Goel further cautions against overreaction to say that overreaction by the policymakers can prove to be very costly. Harmful effects of such overreaction become clear too late and they are difficult to reverse. Dr. Goel points out that taking Indian repo rates too high due to an overreaction imposed heavy costs on the Indian economy in 2011, in 2014 and 2018. As a result of it, a credit and investment slowdown was aggravated and sustained in India. And as we see it, that slowdown continues to linger on. She then cautions against the rapid interest rate increases that we see today and says that high uncertainty also calls for calibrated and slow steps. If demand anyway slows down, less policy tightening by the Reserve Bank will be required. If the inflation being targeted by the policy is headline inflation with a large commodity component, as it is the case of India, for which fiscal action as compared to monetary action has greater impact, then there is more responsibility on the government to act as compared to actions by the Reserve Bank of India. In other words, she hints the fact that fiscal action from the government is also needed and it cannot just be monetary policy action by the Reserve Bank of India to tackle the current problems. She finally says that large hikes were required in India to reverse steep pandemic time cuts. Since that is already completed, going slow now will allow the policy to be agile and real data-based. Extremes are always dangerous and 100% front loading of the interest rate hikes can easily overshoot and cause damage. She therefore says that moderation is better for India instead of big rate increases. The strong and direct remarks of Dr. Ashima Goel about the monetary policies of central banks show that she is particularly wary of sharp and steep increases in interest rates by central banks, which are not based on real data, but are instead based on forward-looking estimates. She thus says that there is no need to overreact in the matter of interest rate hikes by the Reserve Bank of India, and that moderation in policy making is the need of the hour. So what do central bankers, what do Reserve bankers say in response to these statements of Dr. Ashima Goel? The counter to the opinion of Dr. Ashima Goel comes from the perspectives of Dr. Michael Patra, the erudite Reserve Bank Deputy Governor, a MPC committee member himself, who said that central banks today race in lockstep to raise policy rates by much more than their own historical experience. After all, he says that the current levels of inflation have not been seen in decades and have thus been unknown to central bankers today. They are thus operating in an uncharted territory. Dr. Patra explains the monetary policy overreactions of these bankers to say that the present inflation shock is unusual and it defeats all conventional forecasting models. The parameters that characterize recent developments are far outside the price ranges predicted by conventional models. In such an unprecedented situation, no one knows what is too far or what is far enough in the matter of monetary policy changes in this environment. Central banks therefore adopt a risk minimization strategy, preferring to ensure that they eradicate inflation while allowing them to correct course and lower interest rates later if necessary. Therefore, justifying the monetary policy action by central banks worldwide, he says that they are balancing the prospects of a recession against the risk of inflation remaining elevated and persistent. Given their mandates and the credibility the central banks work hard to earn, they prefer now to err on the side of hawkishness in their determination to bring inflation to targets, fearing a repeat of the 1970s global crisis. Thus, he is very clear that this is an uncharted territory and the hawkishness is what they prefer to err towards. In this discussion about whether monetary policy changes should be extreme as we see or moderate as Dr. Ashima Goel suggests, and whether overreaction by the central banks is justified, two critical issues get ignored. The first is that extreme, sharp and sudden interest rate changes are certainly avoidable because they bring sharp swings and volatility and uncertainty in the economy when they are done as well as when they are later undone. It causes a roller coaster effect in the overall economy from phases of high interest and low money supply to phases of low interest and high money supply, which can be avoided through carefully measured policy changes based on real data and not based on forward estimates, as Dr. Ashima Goel points out. The other issue is that in order to stabilize growth and prices and to keep them in an acceptable and manageable range, there are mainly two policy options for a country, which is monetary actions by the Reserve Bank of India and fiscal actions by the government. Fiscal policy initiatives consist of changes in tax rates and government spending, while the monetary policy ones consist of changes in interest rates and money supply. Since fiscal policy formulation involves politics and legislation, which invariably take time and which invariably cause delays, it is monetary policy action by the Reserve Bank which becomes the first line of action, being easier to initiate and later unwind too. Moreover, the fiscal changes are difficult to reverse and their time lag is much more as compared to the monetary policy decisions by the Reserve Bank of India. For example, a decision related to government expenditure to pump money into the economy starts with a parliamentary budgetary approval to spend, which is a slow process. Then the government needs to arrange the funds for it and then finally incur the expenditure. It's a long and slow process. While monetary policy changes are relatively far more quicker and they are easier to implement too. Thus, in such times of grave crisis, which needs immediate action, it is monetary policy that is spearheading the attack against inflation, etc. As a reflection of the extreme nature of the crisis, the monetary policy today, the changes in it, they too have been extreme. But then the volatility that they cause, the damage that they cause, the uncertainty that such extreme changes cause are certainly long and they linger. And it is better that extreme measures are avoided, moderation is resorted to the extent possible, as Dr. Ashima Goel contends. This is Akhilesh Bhargava signing off till we meet again. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.